Okay, so who am I? Some of you may or may not know me. About 5 years ago, I wrote a New York Times bestseller called The Colder War. So when the publisher, it was kind of an unexpected hit. It became the bestseller for the publisher in 2014. And it was basically on the geopolitics of my thesis of the energy paradigm, and we did a lot of history in that. So what happened was, because of the success of the first book, the publisher really was pushing me to come out with a second edition or a new book. So my editor and I spent the Christmas holidays of 2015 coming up with a thesis, and the publisher absolutely hated it. Oops, sorry. And the publisher absolutely hated it. And essentially what happened was they wanted to just sell books. They didn't care about the actual theory of the book. So me and the publisher kind of went our own ways, and I decided to publish it for free. It's essentially called The Boom, the Bust, and the Echo. Is a thesis that I've based all of the success of my fund and my personal investment track record on. And that's what I'm going to focus on today, and how to position yourself in the resource market for that. Okay, so what is the boom, the bust, and the echo? And this is a free book. You actually don't make much money in books. Here's some little facts. Over 80% of the books sold, and we were number 8 for the most seller. So my book was the 8th most seller in 2014. And over 80% was sold on Amazon. Amazon takes about, I think it was like 72% of the ticket price, then the publisher. And I think we got, I don't know, like 60 cents on the ticket price net to the author. So it's really Amazon that makes all the money. So I said, screw this, give it free to my subscribers. And it's based on this thesis I have about specifically cyclical, volatile stocks like the resource sector, energy, and both mining. And I'm going to show how this has been the basis of my whole investment track record. Okay, so Copper Mountain. Yesterday, Jim O'Rourke, who's part of the Canadian Hall of Fame, the Resource Hall of Fame, he's got the Order of British Columbia. I met him in 2006, and I became the largest individual investor in Copper Mountain based off of this thesis. Everybody in mining was getting into, like, you know, the Okanagan and buying vineyards and doing all this. Yet if you drive by Highway 3, how many people have ever gone to the Okanagan on Highway 3? You look at these whole kind of things that look like pyramids, those are the dumps. Yet everybody kind of just assumed that this mine would never come back. I started doing all this research. Jimmy had this thesis that, hey, maybe with $2 copper, we can connect the saddle zone of these 3 pits. And Copper Mountain was the first company in Canada to shoot Titan 24, which is a deep geophysics. And when we went to the site for the first time, I went to the site first time in 2006, it was literally like someone just closed the door in 1997, 1998. Coffee was still dried in the coffee cups. Papers were still on the desk. It was like someone left on Friday and we showed up on Monday morning. All the data was there, and yet nothing was digitalized. So we were one of the first companies to take analog data and digitalize it, use new software to put together, and there was over 330,000 meters of drilling to that point. Copper Mountain in World War I provided 25% of Canada's copper for the war effort, and yet people forgot about this project. It's only 300 kilometers from downtown Vancouver, so if you took all the core from my office to Vancouver to the office at the mine site, you could connect it with how much core was drilled. I thought, hey, this is a pretty good bet. So I became the largest investor, and because of that, Jimmy asked me to join the board. But there was so much inherent value that I went to some big players at the time. Okay, literally some guys who became my very close friends, and I don't want to embarrass them at the time, but I had to raise the money for it. That was my role. And we offered them a $5 million PP with a $5 million valuation. I put $1.5 million in, and everyone thought, no way, copper's never going to go to $3 or $2.50, because it was kind of a tough time. Well, think about this. Newmont Mining used to operate this in the 70s, and then in the mid-80s, they sold it for $1. That's how much Newmont Mining sold it to Princeton Mining, because Newmont Mining used to be a major copper producer. Then the board got together and said, hey, we don't like the valuation copper producers are getting, so let's become gold producers because they get 3 times more valuation on the balance sheet. So they also sold the old Butte mine to a guy named Washington, and that was for $12 million. Washington bought it. Everyone knows, the Wash Corp. They bought it because he had a big construction company in Montana, and he wanted a big hangar to park all of his trucking equipment. A few years later for him, they put it back into production. He makes $3 million of free cash flow a day at $3 copper, and he paid $12 million for the mine. Now, granted, he put more money into it, but at the same time, Newmont sold Princeton. So I went, okay, let's do this. And all these examples are going to be companies that I stood here on this panel at the VRIC and said, really do your homework on this. I'm a big shareholder in this. And it was January 2009. Now, for 2 years, I looked like a total wrong. People would mock me about this. All the trolls out there would make comments online going, oh, Marin said this stock at this price and it's down 7% or whatever. Less than 2 years later, you would have made over 10 times your money. I went on BNN, back when BNN mattered. Now they get less than 5,000 viewers a day. So like Cambridge House gets literally 20 times the views online than BNN. And I went, I was young and I didn't know these rules. As a director, you're not allowed to say, hey, I'm buying as an insider, Jim O'Rourke's buying as an insider, this is how you make 10 times your money. I was wrong, you would have made 18 times your money. Now, what was the thesis here? There was inherent value, it was a past producer, it was a non-AK-47 region. It had clean copper. Now there's a very big thesis here about clean copper and how the smelters are going to start paying a premium for clean copper versus dirty con, because as the big projects like Escondida go deeper and deeper, there's no shortage of copper, but there is a shortage for clean con. Okay, so this is kind of what I get into my thesis. But again, there was the boom, there was the bust on this, and my average price was $1.50 in the IP. I think it was $1.45 in the IPO in 2007, and it went down to 33 cents. And I stood up here on the show, it was about 40 cents, and I said, look, I'm going all in. And I bought the biggest block in the market, and it was a tough 12 months. The market was like, are you gonna go bankrupt? Are you gonna do this? But think about this. When I stood here at the show in 2009, it had $17 million in cash and a $12.5 million market cap, a permitted bankable feasibility study with a project in BC that was a past producer, and Mitsubishi said they would be our partners in joint venture. And yet the market said, yeah, we don't really believe you. It's $12.5 million market cap. Those are the opportunities you get in this market. So now we're going to get to Africa Oil. Here's another story. I actually went and brought this project to Lucas Lundin. I stood here at the VRIC in January 2010 and said, look, I'm the 4th largest shareholder of this company. I have financed it 3 times. And people just couldn't get their mind wrapped around looking for oil in Kenya. And you had this guy named Keith Hill, who's an incredible oil entrepreneur, backed by the Lundins, and yet no one cared, nobody, until Tullow stepped up and said, wow, you guys are onto something world class. And yet we would go on BNN, we'd do the whole spiel to try to create excitement. When we went on the first site visit, it was literally the president, the chairman, Keith, and myself. Jim Phillips, Keith, and myself, and we talked about how are we going to show the ability and the potential of this project. Well, just like Copper Mountain had all this old data, my thesis on this project in the 10BB block was Conoco drilled it 20 years earlier, and it had incredible geology. I had Dr. Buston, who is a well-known geology professor that taught both my wife and I. My wife's a geologist at UBC in our geology courses. And he spent months on this, and they didn't have the technology to be able to economically extract the oil. But my thesis was technology is improving. The asset's been de-risked, but nobody's really paying attention to the old data because it's Kenya and people there was no one there yet. Well, literally a couple of years later, I'll tell a funny story. It's no secret I had a quadruple bypass in early 2012. Keith phones me up and goes, Marin, because I ended up selling it to my subscribers, put out a sell at 380 because it popped up, and he goes, did you have a heart attack because you saw the stock price is $12 a share and you sold it while I'm in recovery in the hospital? So that was Keith's way of saying, sucker. So the point is it was the boom. Conoco had a huge run with this in the late 90s. Then the reality, they couldn't extract it. And then everybody forgot about it for 10 years. Then when Africa Oil went for it, people didn't quite understand it. It had an incredible run. Hundreds of millions of dollars was raised. And now the company is in the echo phase. It's essentially trading just above cash. Those are the opportunities we'll see. So it's the boom, the bust, and the echo. Now, Northern Dynasty, probably the most loved or hated stock in the resource sector, depending who you are. In 2011, I remember sitting up on stage going, wow, Bob Dickinson and Ron Thiessen, they have a $25 stock. There's rumors across the street that it's going to get bought out at $30 or $28.50. Every major in the world, whether it was Rio Tinto, Anglo, BHP, they all, Rio bought 19.9% of the company. Anglo put up $700 million without even earning a single percent into the company as a joint venture. And Mitsubishi came in and bought a big block into the market. They were the second largest shareholder. In the market, all this happened, the social license factor, the price of copper corrected, gold corrected, and the stock went from $25 to 45 cents. So as an alligator, I started getting very interested. So I think it was in the 2016 January show, I brought both Bob Dickinson and Ron Thiessen on stage. Ross Beatty was up on stage. Lucas was up here, and we all put millions of dollars into a financing. And now I'm going to really talk about the private placements and the advantage you get into private placements. And that is the most incredible way to get what I call a 2-for-1 win. So here's a story that had over $700 million spent on the project, and it had a market cap of $40 million just 5 years later. What's changed? Did the deposit, did they drill $700 million worth of drilling and prove that the project doesn't exist anymore? No, it was the opposite. It was all about social aspects. It was about the perception of the project. Trump wins the election, this thing rips to $4 a share, and with the warrants, you would have made 18 times your money in 12 months. If you bought in the market, you would have made about 10 times your money. But again, it was the boom, the bust, and the echo. And the greatest lesson Rick Rule taught me when I was kind of his right-hand man on the street learning the ropes was, Marin, you want to do a private placement with the management teams when they need you, not when you need them. So let me explain what he meant by that. When they need you is when everybody else in the market is invested. I'm a big believer in having cash, and my subscribers know the allocation. In my newsletter, I talk about you should be this much cash. Here's your investments. Here's your speculations. Never, as a speculation, never have more than 5% of your resource portfolio exposed to a speculation. Never have 10% of your resource portfolio for an investment. And when you have cash and the market's tough, and we're still not at a low. I believe we're going a little bit lower. But in our market, when you're competing with investment bankers and the generalist funds have funds to deploy, that's when you want to pull back. The alligator pulls back because the management teams don't need me. And as much as you like these management teams and as much as they're my friends, they're mining entrepreneurs and they're going to do what's best for their shareholder. But when there's no one else on the street financing them, that's when you can get a full 5-year warrant out of someone like a Ross Beatty, an Equinox, or you can get a warrant out of Lucas in a bad market. Remember, we got a warrant on Africa Oil, or an Equinox, a warrant with Rick on his deal with Sprott. So you want to invest when no one else is writing big checks. When the bankers are running around and making their big fees, that's when you want to step back. So let's get into the tech sector. What is this boom, bust, and echo? So from 98 to 2000, you saw the big boom, the bust, and then the echo. And this is where I want to focus everyone in the resource sector, where the 10x opportunity is right now for us. So the echo, and then everyone knows what happened to the tech sector. Now let's pull up the resource sector. So from the early 2000s to the global financial crisis, we had a big boom, the bust. But why was there no echo? Why was there no echo between 2000, let's say the 9, it quickly rebounded? Anyone have an answer there? Stimulus, quantitative easing, all of that money that was injected into the markets, it wasn't ever seen before. And the markets rebounded. And boy, when financial heroin kicks in and the financial withdrawal kicks in, we kind of went into a bust till about early 2016. A lot of market pundits are saying, that's it, we're getting into a bull market. I'm saying, no, no, no. We're going to be in an echo for a couple of more years before we get into the next run. That's my point of bringing such a variety of speakers, where Peter Schiff and the Rick Rule and the Doug Caseys of the world are saying, hey, gold's going a lot higher. There's a reason why I brought Brent and Eric to say, well, hold on a second. Here's a different view. And what I'm saying is, ultimately, both will be right, but in the near term, I'm with Brent and Eric, and we are in an echo. But that's okay. You can buy big positions in good companies, like Mark O'Day just gave a breakfast talk. Like I said, in Liberty and Sun Metals, I'm a big shareholder, and you can build discounted, like yesterday, how many people were here yesterday morning? Okay, so Ross Beattie's put in over $100 million of his own money at a higher price than what Equinox is trading today. So let's just think about that for a second. In a normal bull market, you're paying a huge premium to the market. So if the chairman and largest shareholder is paid a higher price than what you could buy it in, that's a good thing, okay? That's one good positive. I'm the fourth largest shareholder. My average price is higher, and we keep buying more stock in crosses. We bought out a fund called Pac Row out of it. We bought a block from Sandstorm. But more importantly, they've now have 2 producing mines within, let's say, by the end of this quarter, Arizona will be in production. And next year, they're going to have their 3rd phase 1 done, so there'll be about 300,000. But it's trading at 0.44 NAV at a conservative 1275 gold. All of the variables are there to say, hey, this is cheap. And okay, so maybe I'll look wrong for 6 months or 12 months, but eventually the value is there. It'll either be bought out at a nice premium because, within 4 shareholders, about 35% or 40% of the stock is there, so they can't steal it from us. It's a well-positioned, well-financed, all their productions are non-AK-47, and it's cheap. That's the key fact here. Okay, so where do I think the big opportunity is going to be here is uranium. But I'm going to share something that's going to really annoy a lot of management teams in uranium. We had the big boom, we had the bust, and then you had this big echo. And it's going to be an echo for a few more years. I don't see $100 uranium anytime soon. I don't see $80 uranium anytime soon. So here's the global uranium production. It's about 160 million pounds. But what I basically put is, my colder war theme, who's an ally of the West? Who's an ally with the former Soviet Union or the Russia angle? You can see that the Russians control or are allied with a big percentage of the global uranium production. But more importantly, it's the enrichment capacity that the Russians really control. So let's face it, the Americans know, the DOE, the Department of Defense know that they've lost the enrichment race. It's going to cost billions and billions and billions of dollars to catch up to the Russians. It ain't going to happen. Where the Americans are going to focus is on smaller enrichment, smaller modular uranium, and this is going to be the shocker that I'm going to tell everybody. So the Russian advantage, I first published this in 2013, where I got into a debate with the president of Cameco, and I said the underfeeding market is going to surprise. Everyone thought it would be 3 to 5 million is what the Cameco guys were saying. I said, bullshit, it's going to be closer to 20 million pounds because the Russians, remember, they have the advantage of working with a weaker ruble, right? If the US dollar is strong, they have that advantage because they sell in US dollars. And I called it devil's cut and the angel's share if you know about the whiskey production. So that's essentially how it works with the tails assay and the SWUs per kilogram, okay? So as SWUs became cheap, the Russians were able to drop their tail percentage and increase production significantly. So that's starting to dry up. But where's the global uranium demand? The Americans are still over 25% of the global uranium demand, and that's not going to change. But you look at the Russians. Here it says 12%. But the Russians are building over half of the emerging markets reactors, but they finance them, they build them, they operate them. More importantly, they provide life of operation of the nuclear reactor's uranium feed. And in most cases, they take away the uranium. And I don't know where they're going to send it, maybe to America. But Just kidding. So here's the trade imbalances. You see the Kazakhs and Canada and Australia, but the Canadians and Australia, we've kind of hedged our future production sales. Look at the Americans, French, where they are. So here's the demand. So this is where I'm getting at. In a worst case scenario, let's take all of the reactors that are supposed to come off because of aging and all that, and you look at the cumulative demand. What you're going to see is the loss is about 100 million pounds of the existing reactors per year, but there's only 162 produced a year. But then we got to incorporate how much is being built, right? New reactors. So I wrote a research report about, hey, if the New York guys want to short this sector, I'll do the research for you. Here it is, I published it. And what it really comes down to this. Here's the uranium demand for reactors only under construction. I remember, I'm making a bare case here, going in a worst case scenario, not planned or potential projects, just projects under construction. And you see what their need is. And here's the result. The net change in a worst case scenario, it's just under 16 million pounds by 2030 is lost. Okay? That's the worst case scenario as expected. Now that's not incorporating black swans where, something happens and, all the French reactors come off or whatever. Or there's a revolution in Germany and they churn back on all the reactors. This is just with planned that you can actually calculate in a spreadsheet. So in a worst case scenario, you have about 16 million pounds come off as expected. So, but here's the US reserve estimates. At $30 uranium, there's about 45 million pounds that are economically reserve produced. At $50, there's 163 million pounds, which is about 3.5 years. At $100 uranium, there's lots and lots of uranium. But here's the point. I actually have visited all of these mines. I've done this for over a decade, kind of been there, done that. Not that I'm bored of the industry, but I've seen as much bullshit, and I can smell it from the management teams when they try to respin an old project. So here's the thing. In 2015, I was asked by the World Nuclear Fuel Market to give a talk, and I met one-on-one with a lot of the nuclear reactors and the buyers, and I said, I've got a very different thesis. And what I think the future bull market will be in is permitted, un-obligated, lower cost domestic US production. Okay? So what does that mean? So a blast from the past. Companies like J&R, Pitchstone, Tri-X, International Enexco, which got bought out by my good buddy there, the Denison guys. Hathor got bought out. I was very early to all these stories, and literally these companies went from 5 cents to $4 a share with $400, $500, $600 million market caps. And these geologists would come up here, show you these maps that look like my daughter, who's 4, colored them, and they really didn't drill that much. Hundreds of millions of dollars went into the basin. And I know that the Hathor guys will say that, and Dale's a good buddy of mine, but I know they're going to say that it was their geology that figured out. It was actually an accident of re-logging the old core that happened. So here's some little marketing coins that I came up with. Wiser uranium production. It's a lot cheaper than being in the cold areas of Wyoming. You don't have to insulate your pipes. You can connect your header house to a pickup truck and move it to the next zone rather than taking these radioactive 2-story concrete insulated header houses that have to be disposed of in a radioactive material. So the reclamation costs more than the production to the construction of it. But at the end of the day, there's no shortage of uranium. What there's going to be a shortage of is permitted, unobligated, US, and in certain areas in Canada. But let's not get too carried away with the Canadian stuff. So the biggest mistake, so I got together in January of 2014, and I brought all the presidents of the producers in the US to this dinner. I said, guys, you're making a huge mistake here. We're in the echo phase. You're depleting your permitted resources in the echo phase of the market. This makes no economic sense. And one president said, well, Marin, I have to because I told the bankers. And I responded with, do you even think the bankers remember who you are? They're on to their next deal for their B's and fees. So what I really thought the US uranium producers should have been doing at that time is define your permitted reserves, you have your built, but be ready to switch on. Because the US imports 94% of all of the uranium that is purchased for their reactors. So what about Section 232? Tariffs. I actually don't think it's going to happen. Ooh, there it is. The big catalyst for the uranium market was going to be Section 232. What I've been telling all the utilities is to create a quota system. And I go back to the world nuclear fuels market. If I was a utility, why would I roll the dice with the Department of Defense and the Department of Commerce and let the uranium guys get all of the uranium or some crazy tariff system that creates all of their purchases above $60, $70? Here's the whole thesis. You know, the US have lost the +1 gigawatt race for the nuclear reactors. They're going to stick to smaller enrichment for their modular market. The DOD is going to want to secure at least 7 to 10 million pounds a year. The utilities are happy with, you know, buying, let's say, 5 to 10 million pounds, so let's say 10 million pounds in a quota system. And let's just say that's around 45, 50 bucks. The producers are happy, EFR and, you know, UR and UEC. That just kind of happens to be the number that they can carry. So they're all happy. Shareholders are happy. The utilities are happy. But then what happens to, let's say, NextGen and fission? And this is going to be a lot of fun because the next panel, I got Dev coming from fission, so I'm going to ask these questions. What if Section 232 doesn't come in and we kind of get a lock with the quota system that I'm proposing is going to happen at $45 or $40 uranium, that the US, Wiser, and ISR can make money at? Because remember, the previous shareholders took the write down and the boom. The echo investors are going to do well in a $45 uranium market. So that's the big thesis. So, you know, I read the NextGen pre-feasibility study, and I'm not making any friends saying here, but I thought it was pretty light. And I think that fission and NextGen have to merge, and I've been saying that for 2.5 years. I was an early investor in the fission. Hell, I was the one who proposed and financed the spin-out of fission out of Strathmore, and Dev won't deny it either because he was there in 2007 when it happened. So, not only did I say which uranium stocks you should buy, I'm probably the only guy in the world that has written a report and said, which stocks should you not buy and why? And it's there on my website. I'm not standing behind some anonymous name in Twitter. I'm standing right here in front of you. I run one of the biggest funds in the sector. I've got one of the best track records in the sector. Does it mean that everything I do has made money? No, but I'm still here as one of the largest financiers in the sector. So read my report. There's a link here that you can do it that my marketing team said, katusaresearch.com/uranium10x. There's a webinar where Rick and I go through 15 years of us investing in this sector together. And we're going to talk about certain characters in the sector to watch out for and who's done well and, you know, the friends, the foes. So there it is.